Welcome to aminacademy.com. In business mathematics, let us explain the comparing traditional and electronics banking. Consumers today have a variety of options of their banking needs. For many years, traditional banking was the default option to conduct bank business. Today's technology, however, gives customers access to banking services that may be entirely online or mobile, as you will see the things below. What is a traditional bank? Traditional banks typically refer to the physical location of your local bank branch. Most people are likely to be familiar with these options. What is an online banking? Online banks allow for many banking functions to be performed through a website. Many traditional banking offer online banking services, but there are some newer banks that exist entirely online and have no physical locations at all. Briefly, you can say traditional banking tends to offer a wide range of service overall, while online and mobile banking typically prioritize digital convenience and user friendly interface. These days, many traditional banks offer online and mobile options too. It's nice to know you have plenty of visible options to explore when banking out what's the best for you. Now, we'll continue further about this detail. Comparing traditional and electronics banking service. To compare traditional and electronic banking through a lens of business mathematics, you must analyze the factors that, that affect the profitability and operational efficiency of both models. Electronic banking, that is e-banking, generally reduces operational cost for the institutions but may require significant initial investment in technology. Traditional banking relies on physical infrastructure and human resources which have higher overhead. Business mathematics of electronic banking. What is cost analysis? Initial capital expenditure. The startup costs for e-banking are often high due to the need for advanced software, secure servers, cyber security infrastructure, and applications development. Operation expenses. E-banking has a lower variable cost per transactions because automation eliminates the need for human interventions. The primary operational cost includes server maintenance, software updates, the IT staff salaries, the marginal cost of servicing a additional customer is near zero. Pricing and revenue. Free structures. E-banks can offer lower fees on or eliminate maintenance fees, attracting more cost-conscious customers. This is made possible by their reduced overhead. Interest rates. With lower operating costs, e-banks can afford to offer higher annual percentage yields (APY) on saving accounts and more competitive interest rates on loans, drawing in more deposits on customers. Customer acquisition cost, that is CAC. Calculating the cost of acquire a new customer is a key metric. E-banks often rely on digital marketing, which can be measured and optimized more precisely than traditional marketing campaigns. Lifetime value LTV, as customers are more likely to stay with a convenient low cost e-bank, their lifetime value can be high. The LTV should exceed the CAC to be a profitable business model. Efficiency metrics. Transaction speed. Automated transactions are processed instantly, reducing manual display, and human error. Break even analysis. The break even points for an e bank will likely be higher in terms of initial investment but lower in terms of transaction volumes due to the low marginal cost. Business mathematics of traditional banking. What about the cost analysis? High fixed cost. Traditional banks have substantial fixed cost related to their physical infrastructure, including rent, maintenance of branch locations, and physical security. High variable cost. The large portion of operating expenses goes to staffing costs such as tellers and customer service representatives. Each transaction requires human labor, making the variable cost per transaction is significant. Paperwork. The reliance on physical custom documents increases material cost and the time needed to process transactions. Pricing and revenue. Free fee structures. High fees are often necessary to cover the overhead of physical branches and staff. This may include monthly maintenance fees and other transaction based charges. Interest rate. Higher cost structure generally leads to lower APYs for saving accounts compared to e-banks. Cross selling. Traditional bank leverage in person interaction to cross sell more complex financial products like mortgages and wealth management services, which can increase revenue per customer. Efficiency metrics. Transaction time. The time it takes for a customer to complete a transaction is dependent on teller availability and foot traffic in the branch. Location based analysis. Bank must use mathematical modeling to determine the optimal location for branches to maximize customer reach and minimize cannibalization of existing branches. Queue theory. Mathematical models are used to manage customer waiting times in branches to optimize staffing and improve customer satisfaction. Hybrid models are the future. Many traditional banks are now adopting hybrid models, incorporating the cost saving technologies of e banking while retaining a physical presence. The mathematical analysis for these models become more complex, involving optimization too. Determine optimal allocation. How much should be invested in digital infrastructure versus branch services? Analyze customer segmentation. Which customers are profitable through digital channels and which require higher cost in person services? Evaluate cost benefit trades off. How does a branch closer to the redirection of resources to digital channels impact overall profitability and customer retentions? So far, we discussed detail about what is the difference, that means comparing traditional and electronics banking. We have that. Please subscribe our YouTube channel.